If I ask you to picture a high-tech, high-margin business, you'd probably picture a server farm in Silicon Valley, right?
Oh yeah, for sure. Rows of blinking lights, absolute silence, maybe a ping pong table somewhere.
You definitely wouldn't picture a garbage truck at 5 a.m. on a rainy Tuesday.
Definitely not. You picture grit, noise, and
Uh,
garbage.
but that is exactly why we are here today. We are looking at a company that has taken perhaps the most unglamorous job in human history, dealing with our trash, and turned it into a masterclass on efficiency.
We're talking about WM, right? Formerly Waste Management.
Exactly. They just dropped their full year 2025 earnings report yesterday, January 28th, 2026. And if you look past the surface, it's not just a trash company anymore. It's a logistics and energy powerhouse.
It's such a classic example of boring is beautiful. When you actually, peel back the layers of this report, you see a business model that is surprisingly sophisticated.
Right.
They're using automation, healthcare integration, and even renewable energy to generate margins that, some software companies would envy.
So that's our mission for this deep dive. We aren't just going to read you the balance sheet. We need to figure out how a massive legacy trash hauler is posting these kinds of numbers.
And we need to understand the mechanics of what their CEO, Jim Fish, calls disciplined execution.
That phrase, disciplined execution, it's key, isn't it? It sounds like corporate speak. But in this context, it tells a very specific story.
It really does. It's about how they're actually making their money.
Exactly. So let's get into it. Let's start with the headlines, the big picture numbers for the full year 2025. Revenue hit $25.2 billion.
Which is up 14.2% from 2024.
A huge jump for a company this size.
A very significant jump for a mature industrial company, yeah.
And their net income for the year was roughly $2.7 billion. But the number that really caught my eye, and I want you to unpack this for us, is the margin. They focused heavily on the operating EBITDA margin. It expanded to 30.1% on an adjusted basis for the full year.
That is the headline number for me.
Okay, pause on that. 30.1% operating EBITDA margin. For the listener who doesn't spend all day looking at financial statements, what does that even mean?
Well, it's exceptionally high.
Because usually, when you're dealing with physical stuff trucks, fuel, heavy machinery, labor, your margins get eaten up by overhead.
Right. Think about a typical logistics or transportation company. They might fight tooth and nail for, a 10 or 12% margin.
Okay.
For WM to hit 30% means they've achieved something we call operating leverage.
Which means what exactly, in plain English?
It means for every extra dollar of revenue they bring in, they don't have to spend a full dollar to get it. They've fixed their costs so well through the automation we'll get into that the extra money just flows straight to the bottom line.
So they aren't just working harder, the machine they built is just running smoother.
Precisely. They achieved their best ever operating expenses as a percentage of revenue. That tells you the cost of running the business is growing slower than the money coming in.
And that efficiency translates directly to cash. Free cash flow reached $2.94 billion. That's a 26.8% increase over the prior year.
Nearly a 27% jump in free cash. That's massive. And that kind of cash gives them incredible flexibility.
So the real question we need to answer is, where is this efficiency coming from?
Yeah.
Because you can't just wish for lower costs.
Exactly.
So let's unpack the engine. They have what they call the legacy business, that's the collection and disposal side.
The trucks and the landfills, the core of what they do.
Correct. And in 2025, revenue in this legacy segment grew by 4.8%. But here's the critical detail. The core price increased by 6.3%.
Okay, so that's key.
Seems to be. But then I looked at the volume numbers. Volume growth was basically flat. It was like 0.1%, maybe 0.3% if you adjust for workdays.
And this is the part that usually confuses people.
It confused me. Usually, if a company stops growing its volume, if they aren't picking up more trash than last year, Wall Street panics. Why is this seen as a win here?
It's completely counterintuitive. In the waste business, not all trash is created equal. Some contracts are heavy, they're distant, difficult to service.
I'm barely profitable.
Barely profitable. So WM has been very deliberate about what we call shedding bad volume.
So they are effectively firing their customers.
Essentially, yes, or at least repricing them. If a route isn't profitable, they raise the price. If the customer leaves, fine. That frees up the truck for a better route.
And if the customer stays and pays the higher rate.
Even better. That's why you see core price up 6.3% while volume stays flat. They're trading busy work for actual profit.
That requires some serious confidence, though. You can only do that if you know the customer has nowhere else to go.
Exactly. And that brings us to their Unreplicable solid waste network. It's nearly impossible to build a new landfill today because of regulations and, EDMBSs.
Not in my backyard.
Right. If WM owns the only dump in the county, they hold all the cards. That network gives them real pricing power.
So it's a moat, a big, smelly moat.
A very, very profitable moat.
There was one little detail in the volume section I thought was interesting, though. It wasn't just strategic pricing. They mentioned that 50 basis points of their volume came from wildfire cleanup efforts.
Yes. And that's a stark reminder of the physical reality of this business.
It really grounds the numbers. We're looking at spreadsheets, but
Yeah.
ultimately, when a disaster happens, companies like WM are the ones on the ground cleaning it up.
It shows their volume is tied to real-world, sometimes tragic events. But getting back to that margin, if volume was flat, how did they improve operating expenses by 150 basis points in the legacy business?
The report points heavily to technology and automation.
Right. And this is where the boring operational stuff becomes kind of cutting edge. They mention things like frontline employee retention and capital investments in the fleet.
Connect those dots for me. How does buying a new truck save money on retention?
Well, think about the job. Being a waste collector is physically demanding. It can be dangerous. If you invest in newer automated trucks, the ones with the robotic arms so the driver doesn't have to get out and lift a heavy bin, the job becomes safer. It becomes less exhausting.
So the drivers are happier, they stick around longer, and you spend less money recruiting and training new people.
Exactly. Turnover is incredibly expensive. By automating the fleet, they reduce turnover. Better equipment leads to better retention, which leads to lower costs, which, you get it.
It's a virtuous cycle.
It is.
It's smart. But there is another part of this report that I think is arguably the biggest surprise of 2025. We have to talk about the healthcare turnaround.
Oh, Stericycle.
WM acquired Stericycle, which is now their healthcare solutions segment. And let's be honest, Stericycle was a mess before this.
Mess is a fair description. In 2024, the operating EBITDA margin for that segment was a razor-thin 1.0%.
1%. That's basically a rounding error. You're doing all that work for almost nothing.
Essentially. But look at 2025. In just 1 year under WM's management, that margin jumped to 13.5%.
And the adjusted number was even higher.
It hit 16.9%, adjusted.
That is an unbelievable turnaround. From 1% to almost 17% in a single year. How do you even do that?
It wasn't just about raising prices. To understand it, you have to look at the SG&A line. That's selling, general, and administrative expenses.
Okay.
It dropped from almost 39% of revenue down to under 23%.
That is a massive slash in overhead. What are they actually cutting?
Think about it. Before the acquisition, Stericycle was a standalone company. It had its own HR department, its own IT systems, its own dispatchers,
C-suite.
its own C-suite. WM comes in and says, we already have all of that. You don't need 2 HR departments to manage drivers in the same city.
It goes deeper though, right? It's about route density.
Exactly. If a WM truck is already driving down Main Street to pick up restaurant trash, and a Stericycle truck was driving down the same street for a clinic's waste, you can share the maintenance depot, you can share the fuel station, you can share the management team.
They stopped treating it like a specialized medical experiment and started treating it like just another logistics problem.
Yes. They integrated it into their field management structure in the fourth quarter. They just applied their efficiency playbook. That synergy capture is what drove the margin from 1% to 17%.
And revenue for that segment hit $2.5 billion.
Yeah.
So this isn't a small side project anymore.
Not at all. It's a significant growth engine now, whereas a year ago it was a drag on the whole company.
Okay, so we've got the trucks, we've got the medical waste. Now I want to get to the part that feels the most, I don't know, sci-fi to me, the sustainability stuff.
Ah, yes. Turning trash into treasure. This is where the business model really pivots from just collecting to transforming.
The report says they completed 7 renewable natural gas facilities in 2025. 7.
And that's part of a much larger strategy.
Right.
They're capturing the methane gas that is naturally produced by decomposing trash in their landfills.
So instead of just flaring it off, burning it into the atmosphere.
They're processing it into renewable natural gas, or RNG.
And here's the kicker for me. They're using it themselves. The report says their fleet includes over 12,000 natural gas trucks. It's the largest heavy-duty natural gas fleet in North America.
Think about the circularity of that. The truck goes to your house, picks up your trash, takes it to the landfill. The trash decomposes and creates gas.
And WM captures that gas, refines it, and puts it back into the truck to go pick up more trash.
That is literally running on your own supply.
It insulates them from diesel price spokes, right?
Partially, yes. But it also creates a whole new revenue stream. Whatever they don't use, they can sell back to the grid.
But it wasn't all sunshine and roses in the sustainability section. I want to push back on this a bit because the report mentions commodity prices.
For recycling, yeah. The market reality there is tough.
The report says the average price for recycled commodities, cardboard, plastic, all that, dropped to about $75 per ton in 2025. It was $92 the year before.
That's a steep drop.
It is. So if the product you're selling is worth less, why are they spending millions to build more high-tech recycling plants? They completed 9 automation projects last year.
It sounds backward, doesn't it? But this is where their manufacturing mindset comes in. In the olden days, recycling was incredibly labor-intensive.
People standing by a conveyor belt picking out milk jugs.
Right. It's expensive, it's slow, it can be dangerous. By installing optical sorters and robots, they're fundamentally changing the cost structure.
So even if cardboard is only selling for $75 a ton,
If it only costs you $40 a ton to process it with a robot, you're still making a healthy margin.
they're insulating themselves from the market. They can't control the price of cardboard, but they can control their cost of sorting it.
Exactly. They're building a factory that works regardless of the commodity cycle. Automation lowers their break-even point.
And the outlook is bullish. They expect to complete 6 more RNG plants and 4 more recycling projects in 2026.
Which is going to have a huge financial impact. The report says by 2027, the sustainability segments, plus their landfill gas royalties, are expected to approach $1 billion in adjusted operating EBITDA.
$1 billion.
Yeah.
Just from the green side of the business.
It's no longer just a PR move. It's a core pillar of their profitability.
So let's look forward. What can we expect in 2026? The company gave some pretty specific guidance.
They did. They're forecasting revenue growth of about 5.2%, taking them to around $26.5 billion.
And the free cash flow number is the one that really jumped out at me.
Mm-hmm.
They expect it to grow by nearly 30%, hitting around $3.8 billion.
That is an immense amount of liquidity. And the drivers for this growth are very consistent with what we've talked about, that core price.
I'm going to guess it's going up again.
It's going up again, another 5.4% to 5.8%. And they expect continued optimization in healthcare to drive another 3% revenue growth there.
So 2026 is looking like a cash bonanza. $3.8 billion in free cash flow. The big question is, what do they do with all that money?
Capital allocation. This is the part that investors love. They're taking a 3-pronged approach. First, they're giving a raise to the shareholders.
The dividend.
Yep, bumping the dividend up by 48 cents to $3.78 per share. That's about $1.5 billion going right out the door to shareholders.
And the second prong.
They're buying back their own shares, planning to repurchase about $2 billion worth of their own stock.
I always like to clarify this for people. Why is a buyback good for me as a regular investor?
Think of the company like a pizza. If they buy back shares and retire them, they're taking slices of the pizza off the table. But the pizza, the company's total earnings, is still the same size.
So the remaining slices just get bigger by slice of the earnings grow.
Your share grows without you doing anything.
Exactly.
So between the dividend and the buybacks, they're returning about $3.5 billion to the owners.
And they're doing all of that while still investing another $2.5 billion or so into new trucks, those RNG plants, and more recycling automation.
It's a very balanced diet of spending. And they're not borrowing heavily to do it. They're aiming to keep their debt level, their leverage ratio, in a very healthy range.
It really paints a picture of a machine that is just humming along.
It does.
So let's try to pull this all together. What's the main takeaway here?
Well, if we synthesize everything, WM is the ultimate example of a boring business operating at the absolute cutting edge of logistics and energy tech. They use 2025 to execute a very disciplined strategy.
Fix the broken healthcare arm, automate the trucks and recycling plants.
And optimize their customer mix. And because they did that hard work in 2025, that disciplined execution, they've set the stage for this massive cash flow year in 2026.
They aren't relying on a miracle. They're relying on the systems they built. They aren't chasing volume, they're chasing value.
That's it.
It's funny looking at this. I don't think I'll ever look at one of those green and yellow trucks the same way again. It's not just a garbage truck. It's a data-driven, gas-capturing, cash-printing machine.
It really is. It's a moving asset that is, in a way, powering itself.
Before we sign off, I want to leave our listener with a final thought. We usually think of waste as the end of the line, right? The end of a product's life. But looking at WM's investments, the RNG plants, the recycling automation, it feels like we're transitioning to a world where waste is actually just a raw material for energy.
That is a fascinating shift.
Right. At what point does the value of what we throw away exceed the cost to pick it up? Are we moving toward a future where the trash in your bin is actually an asset?
It's a provocative question. I mean, if they're generating $1 billion from sustainability, we might be closer to that reality than we think.
Something to mull over the next time you drag the bin to the curb. That is it for this deep dive into WM's 2025 earnings. Thanks for listening, and we'll catch you on the next one.